Imagine you're a Domino's delivery driver. You just dropped off an order. Before you can pull out of the driveway, your phone vibrates. Next delivery. GPS route already mapped. Timer already started. Every turn is tracked. Every second measured against the algorithm's prediction. Stop for gas? Flagged. Bathroom break? Noticed. Your efficiency score updates in real time. Too many deviations and the orders stop coming. The algorithm doesn't care that traffic was bad or the address was wrong. It just knows you took 11 minutes when the model said 9. This is what a $200 stock price buys you. This is Domino's, the pizza company that convinced Wall Street it was the next Amazon. Let's rewind to 2009. The economy was circling the drain, Barack Obama had just moved into the White House, and Domino's Pizza was serving what can only be described as edible cardboard with a thin smear of something that vaguely resembled tomato sauce. The pizza was bad, not subjective, I prefer thin crust bad. Objectively, measurably, focus group confirmed, terrible. When Domino's actually bothered asking customers what they thought, they heard things like, the crust tastes like cardboard, totally devoid of flavor, and the sauce tastes like ketchup. One person said it was indistinguishable from the box it came in. Another said Domino's was what you ordered when you'd given up on everything and just needed calories before passing out. Domino's wasn't always this pathetic. Founded in 1960 by Tom Monahan in Ypsilanti, Michigan, the company built its empire on a simple promise: fast, cheap pizza. Not good pizza, fast pizza. The famous 30 minutes or free guarantee that ran from the 1980s until 1993 wasn't about quality, it was about speed. Get it to you before you sobered up and realized you could have called literally anyone else. By the late 2000s, that strategy had run its course. Consumer tastes were shifting. People actually wanted food that tasted like food. Revolutionary concept. Pizza Hut had stuffed crust. Papa John's was pushing better ingredients, better pizza. Local places had actual Italians making actual pizza. Domino's had a 30-year-old speed gimmick and a product that tasted like regret. The numbers were brutal. Market share bleeding. Stock price hovering between $3 and $8 per share. Single digits. For a company with over 5,000 locations across the United States alone, that valuation meant Wall Street thought Domino's was essentially worthless. By 2009, they were staring into the abyss. Same-store sales declining. Quality reputation destroyed. The business model, get cheap pizza to people fast, was working exactly as designed. The problem? Nobody wanted it anymore. They had a choice: actually fix the pizza and rebuild from the ground up, or die slowly while competitors ate their market share, which would have been more appetizing than eating a Domino's pizza. What happened next was both. Sort of. In December 2009, Domino's did something almost unheard of. They admitted in a national advertising campaign that their pizza was garbage. The ads were brutal. Real customer comments on screen. Totally void of flavor. The crust tastes like cardboard. Worst pizza I ever had. Then, Domino's employees, including executives, reading these reviews and looking genuinely wounded. The message was simple. We heard you. We sucked. We're fixing it. It was honesty as a marketing gimmick. Transparency as a sales pitch. And it kind of worked. They actually did improve the recipe. New garlic seasoned crust. Better tomato sauce with more herbs. Real cheese instead of whatever that plasticky substance was before. Did it suddenly become gourmet? No, but it went from inedible to acceptable, which, for Domino's, represented a massive evolutionary leap. But here's the thing. The pizza turnaround wasn't the real story. The real story was happening in conference rooms and IT departments, where a decision was being made that would reshape the entire company and fool Wall Street for over a decade. Patrick Doyle, who became CEO in 2010, came from traditional pizza operations. He understood the restaurant business, but he saw something most pizza executives didn't. The future wasn't about making the best pizza. It was about making ordering pizza as frictionless as humanly possible. So while they were tweaking tomato sauce recipes, Domino's was placing a much bigger bet. They started dumping money, serious money, into digital infrastructure. Online ordering had launched in 2008. The pizza tracker, that little progress bar showing your order moving through stages, debuted the same year. Mobile apps arrived in 2011. By 2012, you could order from your phone, tablet, laptop, basically anything with a screen. The strategic choice was clear. Become the best at ordering pizza, not making it. Wall Street started paying attention. The stock ticked up from $8 to $10, then $15. Analysts began asking questions. Wait, is this a restaurant play or a technology play? And that's when Domino's realized something beautiful. Wall Street doesn't care if your pizza tastes good. Wall Street cares if you can put digital transformation in your investor deck and say it with a straight face. So what does becoming a tech company actually look like when you're still fundamentally in the business of baking flour and cheese? Let's start with the pizza tracker. This thing launched in 2008 and people lost their minds. It's literally just a progress bar. 5 stages. Order placed. Prep. Bake. Quality check. Out for delivery. That's it. You're not actually watching your pizza in real time. You're watching a timer tick through predetermined intervals based on average kitchen workflow. But in 2008, this felt revolutionary. It felt like innovation. Then the platforms exploded. By the early 2000s, over 75% of Domino's orders were coming through digital channels, not phone calls. Apps, websites, smart speakers. You could order through Alexa. Alexa, order my usual from Domino's. Through Google Assistant, through your car's dashboard if you had the right integration, Facebook Messenger, Twitter. They built a chatbot named Dom. You could order pizza by sending them a pizza emoji. Just fire off an emoji and your saved order gets triggered automatically. They hired hundreds of software developers, not pizza makers, developers, data scientists, engineers, built proprietary point-of-sale systems that franchisees were required to use, created something called Domino's Digital Ventures, which sounds like a Silicon Valley VC fund, not a department inside a pizza chain. They built actual data centers, custom logistics software to optimize delivery routes, machine learning algorithms to predict demand and position ingredients. The tech stack was legitimate. This wasn't vaporware. The ordering infrastructure genuinely worked better than anyone else's in the industry. Compare it to Pizza Hut's website that looked like it was designed in 2003 and abandoned. Compare it to Papa John's app that crashed during the Super Bowl. Domino's built the best digital ordering experience in pizza. Hands down. No competition. But here's the thing. It was the best ordering experience for pizza, not the best pizza. All these engineers, all these data centers, all this machine learning, all of it was in service of getting mediocre triangular bread to your door slightly faster than the competition. Wall Street looked at the developers and the apps and the machine learning and said, this is a tech company, and the stock went vertical. Let's talk numbers, because this is where it gets truly absurd. In 2010, when Patrick Doyle took over, Domino's was trading around $11 per share. By 2015, it hit $100. By 2020, it crossed $400. That's a 40 times return in a decade. 40 times your money. Here's the kicker. Between 2010 and 2020, Domino's stock outperformed Amazon, Google, Apple, and Netflix. Let that sink in. A pizza chain with a 2-decade reputation for cardboard crust beat the tech giants that actually invented the digital economy on stock returns. At its peak in 2021, Domino's had a market capitalization around $18 billion. For comparison, that's more than Macy's, GameStop, and JetBlue combined. Wall Street was valuing a franchise pizza operation the same way it valued department stores and airlines. Except analysts weren't using restaurant metrics anymore. They were using tech multiples. A traditional restaurant company trades at a price-to-earnings ratio of maybe 15 to 20. Domino's was trading at 35 to 40. Tech company territory. Software company territory. Analysts literally started calling it a tech stock masquerading as a pizza company. And they meant it as a compliment. The narrative was gorgeous. Revenue growth driven by digital transformation. Same-store sales increasing because frictionless ordering drove more frequent purchases. The apps weren't just convenient. They were revenue engines. Every click was data. Every order was a learning opportunity for the algorithm. But here's what nobody wanted to talk about. Underneath all the apps and data centers and engineer salaries, Domino's was still a franchise operation with over 6,000 locations that looked exactly like they did in 1995. The stores were still boxes with ovens. The workers were still making minimum wage. The drivers were still using their own cars, burning their own gas, driving through traffic to hand-deliver pizza. The product was still pizza, mediocre pizza. Wall Street decided that building a really slick checkout experience was the same thing as being a technology company. The market convinced itself that optimizing the last mile of pizza delivery justified a $400 stock price. This is impressive bullshit. Genuinely impressive. But it's not tech. Remember that delivery driver from the beginning? Let's talk about what innovation actually feels like when you're the one being optimized. Every delivery is tracked, not just start and end points. Every turn, every stop, every second. The GPS logs your route and compares it to the algorithm's optimal path. Deviate even slightly and the system flags it. Why did you take Main Street instead of the bypass? Why did you stop for 45 seconds at that intersection? The app wants answers. Delivery time is monitored down to the second. The system calculates how long each run should take based on distance, current traffic data, and historical averages. Consistently slower than the model predicts, you get dinged. Too many dings and you stop getting the good routes. Keep it up and you're gone. Customer ratings affect everything. 5 stars? Priority access to the next batch of orders. Anything below 4? You drop down the queue. The customer can rate you on speed, friendliness, whether you smiled enough. One bad interaction, one angry customer who was mad about something completely outside your control, and your score tanks. They call it gamification. Leaderboards showing which drivers are fastest. Badges for completing deliveries under time. Competition between drivers for who can maintain the highest efficiency score. It sounds fun until you realize it's designed to make you drive faster, take fewer breaks, and view your coworkers as competition for scraps. The app has to stay running your entire shift, not just during deliveries, the whole time. Even when you're sitting in the parking lot waiting for orders, the system is watching. Go to the bathroom too often? The algorithm notices. Take too long between runs? Flagged. This is what tech innovation looks like at ground level. It's not revolutionary. It's Frederick Taylor's time and motion studies from 1911 with a GPS chip. The exploitation is old. The interface is new. Scientific management with a touchscreen. And the drivers aren't the only ones getting squeezed. Now imagine you're a franchise owner. You invested $200,000 to $400,000 to open a Domino's location, went through training, hired staff, bought the ovens, the ingredients, the signage. You're ready to run your business, except it's not really your business anymore. To operate as a Domino's franchisee, you must use the corporate point of sale system, not a cheaper alternative, not an open source option, the one Domino's sells you. You pay for every update, every software patch, every new feature they decide to roll out, whether you want it or not. You must use the corporate ordering platform. Every digital order that flows through the app or website, Domino's corporate takes a cut. You wanted digital orders because they're convenient and they increase volume. Congratulations. Now you're paying a percentage of every single sale to the parent company for the privilege of receiving orders through their system. Technology fees are mandatory. Fee for app development. Fee for data analytics. Fee for digital marketing campaigns you didn't request. Fee for cloud infrastructure. Fee for platform maintenance. These fees increase regularly. You don't get to opt out. Equipment must be corporate approved. Even when there are cheaper alternatives that do the exact same thing, you have to buy the version Domino's authorizes. They call it quality control. It's a monopoly tax. Here's the beautiful trap. The more successful you are with digital orders, the more you pay to corporate. Your best month? That's Domino's corporate's best month too, because they're skimming fees off every transaction. You're working harder, hiring more drivers, dealing with more customers, and your profit margin is getting squeezed by the very systems that are supposed to help you grow. Franchise owners wanted digital tools. What they got was a landlord with better branding. Corporate doesn't care if your location is profitable. They make money on fees whether you're thriving or barely surviving. The franchise model used to mean you owned your business and paid a royalty for the name. Now it means you rent the technology to run a business you technically own but don't actually control. Vertical integration dressed up as partnership. So here we are in 2025. The stock has cooled off from its peak. Market cap hovers between $13 billion and $15 billion, down from the highs, but still impressive. The question still hangs in the air. Is Domino's actually a tech company? Let's do some honest accounting. What percentage of Domino's revenue comes from technology products sold to other companies? 0. They don't license their software to other businesses. They don't sell their ordering platform as a service. They don't run cloud infrastructure for third parties. 100% of revenue comes from selling pizza, breadsticks, and wings. Compare profit margins. Amazon Web Services operates at 30% margins. Microsoft's cloud business? Similar. Google Cloud? Same range. Domino's? About 12% to 15%. Restaurant industry margins. Because they're a restaurant. Look at actual tech companies that deserve the label. Shopify builds e-commerce platforms and licenses them to thousands of businesses. The platform is the product. Salesforce sells software. The software is the product. Domino's sells pizza. The software exists to sell more pizza. Even Uber, which is also questionable as a quote-unquote tech company, at least has an argument. They built a platform connecting riders and drivers. The platform has some independent value. It's still debatable, but there's a case. Domino's owns the pizza shops, employs the workers, bakes the dough. The app is a checkout interface for a traditional franchise retail operation. That's operational excellence. That's smart business. But it's not a technology business. Wall Street is starting to figure this out. The stock is increasingly being re-rated as a restaurant company with good margins, not a tech disruptor. Analysts who called it a tech stock in pizza clothing are quietly backing away from that language. Here's the honest take. Domino's built the best pizza delivery logistics system in the industry. Their digital infrastructure is genuinely impressive for what it does. They made ordering pizza easier than anyone else. That's a real accomplishment. But being good at technology and being a technology company are fundamentally different things. Walmart uses sophisticated logistics software. They're still a retailer. FedEx uses advanced route optimization. They're still shipping. Domino's uses apps and data to sell pizza. They're still a pizza company. What's the lesson here? Because this story isn't really about pizza. The lesson is simple. Wall Street rewards the appearance of technology more than the substance of it. Any company in any industry can hire developers, build apps, throw digital transformation onto investor slides, and watch the multiple expand. Execute well enough, and the market will give you a tech valuation even when you're still fundamentally selling a physical product made by minimum wage workers. The real innovation here wasn't in the product. It was in financial engineering. Domino's figured out that a better ordering interface meant they could trade at double the industry multiple. That's genuinely impressive. But it's not what we usually mean by technological disruption. And this pattern is everywhere. WeWork called itself a tech company when it was really just subleasing office space with free beer. Uber calls itself a tech company when it's fundamentally running an unlicensed taxi service with an app. Every industry is trying to cosplay as Silicon Valley because that's where the valuation multiples live. But here's what actually matters. The workers pay the price for this innovation narrative. Algorithmic management isn't new. It's Frederick Taylor's scientific management from 1911 with GPS tracking bolted on. The exploitation is old. The interface is new. Franchise owners pay the price too. What used to be partnership, you pay royalties for brand access, became rent extraction. Mandatory technology fees that climb every year. No ability to opt out. The language is innovation. The reality is digital landlordism. This model is spreading everywhere. Every company racing to be valued like a tech stock. Every industry deploying algorithmic management and calling it disruption. But the pizza is still pizza. The work is still work. The money still flows upward to executives and shareholders, while the people doing actual labor get tracked, measured, optimized, and squeezed. Maybe the market forces a reality check eventually. Valuations correct, narratives shift. But by then, the executives who engineered the transformation have already cashed out their stock options. Domino's built excellent apps to sell mediocre pizza and convinced Wall Street it was building the future. The lesson? Sometimes the revolution is just better marketing. Thanks for watching.